Good morning, everyone. It is Thursday, May 14th, 2026. It's another beautiful spring day here in the Midwest. It's finally warming up. When I turned on my screen this morning, I saw that there has been an incredible discovery that perfectly explains the fundamentals behind the scenes driving the most powerful stock market rally in history. So let's check that out, and then we'll go through some technicals and the gasoline and energy forecast for the next couple of days here. AI solves everything, proving growth is limitless. New era of abundance dawns as technology transcends all limitations. It says here that this is the end of scarcity. Artificial intelligence has unlocked infinite potential across every industry, resource, and market. Analysts say the combination of AI, automation, and exponential innovation makes limits a thing of the past. Goldman hikes year-end target for NASDAQ to infinity. Says Goldman Sachs stunned investors Monday by raising its year-end NASDAQ target to infinity, citing unprecedented AI productivity, endless monetization opportunities, and a new paradigm of limitless growth. Numbers are obsolete. The future is infinite. AI drives exponential future. Analysts now use new metrics: infinite earnings, infinite margins, infinite valuations, and of course, infinite potential. The only direction is up. The only limit is your imagination. And markets are celebrating the end of limits by, of course, pressing the all-time high. It seems that every day we come in here that the market is on the all-time high and it persists. It does not dip more than a few tenths of a percentage point before getting bought up again. The NASDAQ is trading at 29,625. The S&P is at another record high. We finally made it to 7,500. 7,504s are going off right now. Let's look at the crude oil. Crude oil, 101.35, going nowhere, not going up, not going down. Gasoline, 358 in the RBOB futures. Not really going up, not really going down, still very near the multi-year high at 370. So the energy market is stabilizing here just above $100. Eventually, I would expect this thing to make a run for the 115 mark that it hit in the first week of the conflict. That could happen anytime soon. That there are no limits in the energy market. The energy market can basically do whatever it wants whenever it wants. So it doesn't have circuit breakers like some of these other instruments. Let's get to some of the other articles real quick. Powell, we can print more oil. So maybe that's why the crude oil is locked where it is and it's not going anywhere. There's a solution. There's a real solution for this. And now this would, of course, make perfect sense. So it says, infinite liquidity, infinite oil, problem solved. In a bold new monetary policy statement, Chairman Powell confirmed the Federal Reserve is now authorized to print as much oil as the economy requires. We have the technology, we have the balance sheet, we can print more oil. You can see that they have the printing press recalibrated here for oil instead of money. So oil supply is now infinite. Markets, of course, love it. That's probably another reason we're on the all-time high with AI solving everything, and now the Federal Reserve can print more oil, probably with the help of AI. Wall Street reacts. This changes everything. Consumers thrilled. Gas prices to zero by summer. So that's going to far exceed expectations that Trump set, where the gasoline price is apparently going to drop, 50% soon. Coming next, Powell, we can print more food and houses too. Now, I think the 3D printing of houses will be a little bit more easy to do than oil. But nonetheless, it appears that they can print whatever they want now. So crisis has been completely averted. Everything's going to be fine, and the stock market's going to go to infinity by the end of the year. I'm surprised it's already not trading at infinity now, but maybe it takes time for these things to work itself out. A quick trip to Zero Hedge. And we see that Iran proclaims safe toll-free passage for 30 Chinese tankers amid Xi-Trump summit. So while President Trump and a lot of CEOs are visiting President Xi in China, Iran is showing some token gestures towards China by allowing their ships to pass through without the toll. And then here's the next article. Trump, Xi put Hormuz, Iran trade, Taiwan at center of historic Beijing summit. They have a lot to talk about here. There's a lot going on. It's going to take them a little while to sort all this out. This one says the market has never done this ever. Never have so many stocks made new lows when the S&P is this strong. So the breadth is terrible. The appreciation in prices is concentrated once again in the few Magnificent Seven type of names. It says here that despite record low sentiment, U.S. retail sales see strongest annual gain in 8 months. Well, retail sales are how much people are paying for things. So with prices completely out of control, I would definitely expect to see retail sales their strongest ever. If prices are basically their highest that they've ever been, then of course retail sales are going to be the highest that they've ever been because that's how much it costs for everything. Futures at new record high on tech, Tehran trade, Taiwan, and tariffs. This was a good article, so I pulled this one out, and there's a lot of stuff to cover in here. You can definitely read it if you want. I had my employee ChatGPT here summarize it for us so that we can get through it a little bit faster without reading it word for word. The main theme is that markets are pushing to new all-time highs despite massive geopolitical and economic instability. This article frames the rally around the 4 T's: Tehran, trade, Taiwan, tariffs. It said, I can add a 5th T, tech, AI melt-up driving everything. Once again, AI is going to solve everything. So, of course, this makes perfect sense. Market narrative, S&P futures and NASDAQ futures continue higher. AI and semiconductor hype is overpowering macro fear. Investors are essentially ignoring war risk, inflation risk, supply shocks, rising yields, global instability. The market is acting as if AI solves everything. Diplomacy will magically stabilize oil. Well, we now learned that the oil can be printed now, so that there's no reason for political factors to stabilize oil. We're just going to print it. Trade tensions will ease. This did have some more information on the Trump-Xi summit. Massive focus on the Trump-Xi meeting in China. Market expects trade progress, semiconductor deals, reduced tensions, reopening of the Strait of Hormuz. Trump and Xi reportedly agree Iran cannot have nuclear weapons. Hormuz should remain open. More investment between the U.S. and China is possible. They're definitely putting deals on the table and seeing what's possible. NVIDIA H20 chip approvals for selected Chinese firms become a major bullish catalyst. Tehran, Iran angle, Iran situation remains unresolved underneath the bullish headlines. Markets are pricing in optimism that diplomacy works, oil flows normalize, no major escalation occurs. However, oil is still elevated at 100. Energy risk remains extreme. Strait of Hormuz disruption is still central to the story. This creates a contradiction. The market is near record highs while the global energy system is still unstable. Very unstable. The worst crisis in history, unstable. Taiwan angle. Taiwan remains a major geopolitical fault line. Concern exists over a possible Iran for Taiwan geopolitical trade-off. Softening U.S. posture toward China. The summit optics matter. Is the U.S. conceding leverage? Is China gaining strategic advantage? Taiwan is described as one of the largest risks in U.S.-China relations. This is ongoing. Tariffs and trade. Markets are betting on tariff reductions, trade stabilization, semiconductor cooperation. Rare earth supply chains remain a major issue. Lots of rare earth elements come out of the Strait of Hormuz that are not making it out there due to the 95% reduction in traffic. China still dominates rare earth processing, critical industrial minerals. We need those to make everything, including things for our military. So the more munitions that we expend in this war, those have to be replaced. We need rare earth minerals for those. Perhaps they'll print more of those too. It won't be an issue. Any trade thaw could massively impact chips, manufacturing, AI infrastructure, tech valuations. Tech melt up, AI is carrying the entire market. I'm not sure that AI is fully responsible for this rally at this point. There seems to be something even bigger than that going on. AI is only worth so much. Despite Goldman hiking the price target to infinity. I disagree with that a little bit. Cisco exploded higher after strong AI related guidance, layoffs to redirect spending into AI. So stock prices jump and go higher when they announce that thousands of people are going to be cut off because of AI. This is the problem that I see with the whole AI revolution, is that nobody's going to nobody's going to be able to work anywhere because AI is going to replace all the jobs. So if AI replaces all the jobs eventually, who are these companies going to sell their services and products to? Maybe they'll just make everything free. Problem solved. Tech is being treated as the safest place in the market, although it is the most dangerous and volatile and most unpredictable place in the market. This escape valve from geopolitical chaos, which allows investors to ignore the largest energy crisis on record and a whole host of other problems that were present before the war began and before the Strait of Hormuz was closed, simply adding more gasoline to the fire. One quote theme: all roads lead to tech. It says, I can talk about the contradiction. Oil prices remain historically elevated. Inflation pressure still building. Bond yields remain high. Supply chains remain stressed. It's a matter of time before we start to run out of things here if this continues. We really can't go on much longer like this. Things are going to start disappearing. Supply chains remain stressed, yet markets continue making new highs. This creates the core question: is the market genuinely pricing reality? Of course not. This is a fantasy land, bubble land. Or is liquidity, AI speculation overwhelming macro fundamentals? Well, that clearly seems to be the case here. Inflation, energy pressure, higher oil costs are feeding into consumer prices, transportation, manufacturing, food system. Markets fear inflation but continue buying risk anyway. Well, there's nothing else to do. Some analysts expect more inflation spikes, harder Fed policy, rising producer prices, yet speculative momentum continues. There was some talk about the Federal Reserve hiking interest rates in the future, but it'll be a modest increase. It's nowhere near what it needs to be to actually curtail and stop the inflation. It's going to be a modest increase here and there. It's not going to make a dent. There's too much debt and there's way too much inflation. A quarter point here and there is not going to do anything. Commodity themes: copper's near a record high, silver's back to $90, oil's above 100, energy inventories repeatedly tightening. We're going to look at the Hormuz deficit clock and get the current metrics. We got the EIA release of inventories and draws yesterday, so I've updated the Hormuz deficit clock. This suggests resource scarcity, industrial strain, supply side inflation pressure. The article basically describes a market trading on AI optimism, diplomatic hope, liquidity, narrative management, while simultaneously war risk, inflation, energy disruption, trade fragmentation, geopolitical conflict are all still active underneath the surface. So, here we go. Let's fix the view. Hormuz deficit clock, global crude oil supply destruction. Here's the date. We're 75 days, 14 hours, 36 minutes, and 45 seconds into this. We're almost at 1 billion barrels. In another day or two, we're going to be at 1 billion barrels lost, estimated, since the strait was closed. We're burning 150 barrels a second, 13 million a day. It's actually closer to 14 million a day, I read yesterday, so I'm going to have to adjust this number Global daily demand 104.91 effective supply. 12.5% of the supply is missing. We have lost 900 barrels, 1,000 barrels so far this minute. Since the hour began, I started this at the beginning of the hour. We've lost 340,000. We're going to lose 91 million this week, 98 million if this number is 14. This is now 2.18 times worse than the 1973 Arab oil embargo crisis, which was 450 million barrels of supply destroyed. That took a couple of months to play out. This is way worse. Inventory reserve status, EIA confirmed. 400 million barrels are going to be released. The United States portion is 172. We can see that from the SPR remaining graph here that this is where we're at right now with the Strategic Petroleum Reserve 388. But here's the pledged draw for the IEA coordinated release. So that's going to put us down about 41% from here. Total SPR draw is 22.3 million barrels. That's how much has actually come out. We have a max draw of 4.4 million barrels per day. So in the event of a major crisis, we're only going to get 4 million barrels out of this thing every day. That's the max draw capacity. Distillate stocks dropped just under 100 million barrels. It is now 9% below the 5-year average. That's what this white marker is, the 5-year average. The all-time high in stocks is around 145, so I use that for visual purposes. Commercial crude stocks have drawn more. We got 444 left. That's down 0.3% on the 5-year average. Gasoline stocks, 207 million barrels, down 5% from the 5-year average. This is the high in gasoline stocks over here to give you an idea of where we're at. So we do still have some stocks, but they are steadily drawing. And of course, the strait remains closed, so there's nothing new that's going to replenish these stocks. They have ramped up production in India and other places, but that depends on the IEA coordinated release. The IEA, this is confusing. There's two separate 3-letter entities here. I apologize for the confusion. We have regular at 445. That's around the national average. It's as high as 529 here now. So it went from 499 to 529 in a few days. So the gasoline is definitely going up. The prices are going up. Diesel 564. Diesel's closer to 650 here. So I will update these numbers. Maybe I'll use the Chicago Midwest values and just start from there. The war premium analysis does not change. The start was 65 at the beginning of the war. WTI is at 101 today. The fair value target for Goldman was 160. Goldman's model assumed a 10-week closure of the strait. We're 5 days after Goldman's expiration date. So this was Goldman's target for 5 days ago. So their model is now wrong and outdated. The best and brightest in the industry, their model is now wrong and outdated. The 52-week high is 117.63 in crude. The discount is $57 a barrel right now from the expected war premium of $95 to Goldman's target. So this is the reality. This is what's really going on. Every day, losing millions and millions of barrels. This is the energy ripple map. So I had an idea to construct the downstream effects of this. And with WTI crude oil at 101, that's up 55% year over year. So 55% higher. WTI is the primary upstream signal. I'll bring myself back here. The price from which every downstream cost in this chain is derived. At 101 a barrel, crude sits $36 above the pre-war baseline of 65 established before the Hormuz disruption. That war premium is not a market abstraction. It is structurally embedded into diesel, jet fuel, fertilizer, and petrochemical feedstock costs that flow through the real economy for months after any crude price move. It takes time for this stuff to work its way through the system. So the damage that's being done right now is going to have a lag effect. It's going to take a few months in order to fully work its way through the system and for us to realize the tremendously adverse negative effects and consequences of it. The signal is also partially distorted. Liquidity flows, derivatives positioning, and intervention expectations mean the futures price does not cleanly represent the physical scarcity or surplus. So, what this is saying is that there are distortions, potentially massive distortions. These have huge contamination effects on the system because lots of things depend on this right now. The energy is responsible for almost everything that we're able to do in daily life. Turn the lights on at home, get in our car, drive somewhere, buy the food that's at the grocery store that has to be shipped. It just goes on and on and on. It is an imperfect input to every model and cost structure downstream that ingests it. So we have the crude oil metrics here. We have diesel and pump prices up 61% year over year. Is up $2.14. It's even higher, like I said. So this is even higher. It's probably about 75%. That makes it the hardest single price signal in the energy complex for the real economy, the price of gasoline. Diesel powers nearly every freight mile, farm machine, construction site, and industrial generator. I said gasoline, I meant diesel heating oil. Unlike gasoline, which is a consumer discretionary cost, diesel is a production input. Its price increase does not just reduce consumer spending power, it raises the cost of producing and moving everything. Regular gasoline at 4.45 a gallon, it's 5.29 here, about 35-40% higher than a year ago, adds consumer pressure on top of the production side squeeze. Distillate stocks at 9% below the 5-year average confirm the physical tightness sustaining this premium has not resolved. Supply cannot absorb the demand values without drawing down further. Freight and transport costs, 28%. Diesel represents roughly 25 to 32% of total trucking operating costs under normal conditions. So the component of this is 28% of the cost. 28% of the cost is the fuel. Carriers face a structural cost increase of approximately 15 to 20 percentage points on operating margin before any other input is considered. Fuel surcharges are typically formulaic and lag diesel price by 1 to 2 weeks. So once again, this stuff takes time to work itself through. So the full freight cost effect reaches shippers within 2 to 4 weeks of a diesel move. So every month, the heating oil futures roll over. So there's 4 weeks right there, and then it'll take, 4 weeks. That's about the lag time. From shippers, it flows to the retail shelf prices in 4 to 8 weeks. So formulaic and lags diesel price by 1 to 2 weeks. So fuel surcharges lag 1 to 2 weeks. Full freight cost effect 2 to 4 weeks. Retail shelf prices in 4 to 8 weeks. So the increase in prices of gasoline and diesel right now, we're going to start to see those effects in about 4 to 8 weeks. It's going to take a little time. Every product that moves by truck, groceries, pharmaceuticals, hardware, auto parts, agricultural inputs carries this cost embedded in its landed price. The tightness in distillate stocks means carriers cannot expect fuel cost relief from inventory normalization in the near term. So inventory normalization in the near term is not going to provide immediate relief. The antidote is not going to counteract the poison right away. The poison is active. The system is compromised. It's going to take time. This is not the instant gratification that everybody is looking for. CPI energy component, this one's very interesting because we just got the CPI and PPI numbers for the last month, and they are not good. They're very, very high. The PPI, I think, was one of the highest ever at 6%. The CPI energy subindex directly ingests pump prices, making it the most immediate financial policy input contaminated by upstream distortion. So, if the crude oil price is not accurate, It's going to bleed into this. This is very important. The estimate of approximately 38% year over year is a weighted interpolation of the gasoline and diesel. So the energy component is up 38%, reflecting relative shares in household and transportation consumption. Beyond the direct energy component, freight cost elevation creates a secondary pass-through into core CPI, the prices of goods that move by truck. This channel is slower, weeks to months, and more diffuse, meaning the full inflation effect of a diesel move does not appear in CPI simultaneously. It arrives in waves. Policy that reads a single CPI print sees only one wave at a time. The shelter component lag of 12 to 18 months means housing costs from a year ago continue dragging CPI higher, independently of what energy does next, compounding the timing problem for any policy response. So, once again, a massive lag effect in the energy numbers and the effect on CPI. So the CPI is already going up. It's already getting bad again. And the energy component of this hasn't even hit yet. Petrochemical and fertilizer downstream effects extraordinarily severe. Feedstock up 55%. Crude oil is the feedstock for ethylene, propylene, benzene, and the full polymer and plastics chain. They have a plastics problem in Asia right now. They cannot get plastics. It is also via natural gas linkage. Natural gas comes through the Strait of Hormuz as well. Double-digit percentages of liquefied natural gas not making it through. The primary pressure point for nitrogen fertilizers, ammonia, urea, and ammonium nitrate at 101 WTI. Petrochemical production and cost remain structurally elevated versus the pre-war baseline. So the cost of these things is already elevated and there's a supply problem. The agricultural consequence moves particularly slowly. Elevated fertilizer costs during spring planting translate into higher food production costs that do not reach consumer food prices until harvest and distribution, typically 1 to 2 seasons downstream. That's a year or two lag. So the damage that's being done right now in the energy market is going to show up in the crop market over the next year or two. So even if the war stops today, we could be looking at massive crop problems a year or two from now. Are you starting to get an idea of just how incredibly dangerous this situation is getting and how this energy market really does affect absolutely everything else? This means an energy price event in early 2026 continues feeding through into the food CPI late into 2026 and 2027, long after the crude price that it caused it has moved on. A central bank reading food CPI in late 2026 may be responding to a WTI price that no longer exists. Airline fuel costs. Europe's going to run out of jet fuel. I talked about this yesterday. Unless they really do something about the situation over there in the Persian Gulf, Europe's going to run out of jet fuel. Jet fuel at approximately $6.48 a gallon, estimated at a 15% premium over diesel, consistent with the IATA observed ultra-low sulfur diesel to jet spread under normal refinery conditions. Fuel represents 20 to 30% of total airline operating expenses. We already had a couple airlines go belly up because of this, making it the single largest variable cost line. At these levels, airlines face a binary response: absorb the cost and compress margins, or pass it through in fares. If you can get a flight in Europe, it's probably going to cost you 10 times as much. Fare increases feed directly into core CPI services. This also affects the CPI later, the downstream lag effect. One of the stickier inflation components that the Fed watches specifically because it is harder to attribute to transitory supply shocks. This closes a loop back into the CPI. The energy price that inflated the energy subindex also inflates the services subindex months later through air travel costs, producing two large distinct CPI waves from a single upstream crude event. Multiple feedback loops possible here. Feedback loops where downstream flows back upstream. CPI reading, Fed policy, dollar WTI. Elevated CPI energy triggers tightening expectations at the Fed. A hawkish Fed strengthens the dollar. WTI is priced in dollars, so a stronger dollar mechanically compresses the crude price in USD terms, even if physical supply conditions are unchanged. A lower WTI print then eases the CPI energy component in the next read, which reduces tightening urgency, which softens the dollar, which lets crude recover. The result is that the policy response to the energy price is partially suppressing the signal the policy is trying to read. The Fed is looking at a thermometer it is partly controlling. Diesel, freight, consumer prices, demand destruction, crude. Diesel at plus 61% year over year elevates freight costs, which pass through to retail prices, which compress real consumer purchasing power. The EIA data already shows this pressure registering. Gasoline demand down 0.8% year over year at 8.9 million barrels per day. Demand destruction visible in the physical data. As demand softens, the crude demand outlook weakens, creating downward pressure on WTI, but distillate stocks remain below the 5-year average, so the physical supply constraint limits how far crude can fall. The loop produces a compressed price band, high enough to keep destroying demand, low enough that supply tightness prevents meaningful relief. Neither the inflation nor the demand destruction fully resolve. They persist simultaneously. Fertilizer cost, food CPI, core stickiness, rate duration. Elevated crude pushes fertilizer costs higher through spring planting. The spring planting opportunity is over right now, so lots of things didn't get planted. That's another subject that we'll touch on later. Those costs embed into food production and arrive in consumer food prices at harvest 6 to 18 months later. When food CPI rises in late 2026, policymakers see persistent core inflation and extend the rate tightening cycle. Higher rates for longer strengthen the dollar, which feeds back into the loop, dampens industrial activity, and compress demand for petrochemicals and fuel. The crude price event from early 2026 is still driving policy decisions in 2027, though the food price channel by which point the crude price may have normalized entirely. 6 to 18 months. Distillate stocks down 9% versus the 5-year average. Gasoline demand year over year down 0.8%. Little demand destruction showing now. WTI war premium right now $36. Total product demand 20.1. The world continues to demand energy at the normal rate, and we have a major supply problem here. I know that was a lot to take in all at once. So take a couple of deep breaths. I'm definitely going to have to go for a walk and chill out. Things are just rapidly spiraling completely out of control here. What's my plan for the rest of the day? I think my plan for the rest of the day is to take it easy. I want to do some script demonstration videos. Maybe I'll get the chance, maybe I won't. Maybe I'll go walk around and try and figure out what I'm going to do when there's no gasoline at the corner, or whether I'm going to be able to survive and, keep the lights on with the energy crisis, and also, you know, tend to day-to-day things like eating. Hopefully, when I go to the grocery store a couple months into the future, there will still be some things on the shelves. I'm going to make some preparations just in case there's not. I have been making some preparations, but I think I'm going to make some more. So, until next time, you guys take care, and I will see you on the next video.